So here we are again. We are on Chapter 2, Question 13a. So we have this John Chang Communications, a PR firm, and he had a bunch of balances as of April 30th, 2019, which I've already taken the liberty to create as my opening balances for the month of May. So I'm using the same worksheet I've done in my other videos. And you can also see that my assets equals my liabilities plus capital as of the opening of this transaction or this question. So we have 10 transactions to process. First one, okay, we purchased $800 of office equipment on account. So if it's office equipment, it's considered an asset. We're increasing the value of our equipment. And if it's on account, we now owe more. So we owe $800 more to a potential vendor, or the vendor that sold us the assets. Item number 2, we paid $600 to reduce the amount owing to a supplier. So we are reducing our cash by $6,000. And we said we're reducing the amount owing to a supplier, so we are reducing our accounts payable by the same. Number 3, we received $5,000 in cash from customers for service rendered. So we received cash, so we're increasing our cash by $5,000. And we provided services for our customers, so therefore we need to record the revenue. Sorry, that account is, my formulas are not quite working. I apologize for this. I will enter it on this line for now. Okay. So we have $5,000 in revenue for services rendered. Item 4 is we paid May's utility bill with $700 cash. So we are using cash up, transaction 4, $700, and it's a utility expense. We are increasing the expense. So therefore, transaction 4, we're increasing our expense by $700, which is a debit and increased utilities expense. Number 5 is we purchased a computer worth $1,500 in the account. So we are buying an asset. We're increasing our asset for transaction 5. And it's on account. So we're increasing our AP for the same amount for $1,500. Transaction 6, we received the bill for $1,000 for advertisements during the month of May, the amount which will be paid in July. So we received the bill, so we need to record it as an advertising expense. So this is transaction number 6, I believe, yes, $1,000. And we will pay it later on, so we're increasing or crediting our accounts payable for $1,000 for transaction 6. Transaction 7, we paid May's salaries with $1,900 in cash, so we're reducing or crediting our cash by $1,900. And we increased our salaries expense because it's the cost of doing business for transaction 7 for a total of $1,900. Transaction 8, the owner withdrew $3,000 cash for personal use. So transaction 8, we're reducing or crediting our cash for $3,000. And the account that we have yet to use in any examples we've spoken about is an account called Chang Withdrawals. And in this case, it's what's considered a contra, an opposite account to Chang Capital. So for an increase to withdrawals is actually a debit versus an increase to capital is a credit. Okay, so an increase to withdrawals is a debit, which is left side, and we took out $3,000. Transaction number 9 is you recognize $9,000 of rent for May, which was in prepaids. So we're being told in prepaids we want to reduce it for transaction 9 for an amount of $2,000, which then becomes a rent expense, an increase or a debit to rent expense for the same $2,000. Transaction 10, we received $4,000 cash in advance for a contract to be completed in 3 months' time. So we have the cash on hand for $4,000. Because we're not completing the work until later, it is not revenue. It's very important. It's not revenue for the current month. So if it's not revenue in the current month, it's considered an unearned revenue. So in order to increase unearned revenue, we need to credit or right side that transaction. The same $4,000 for transaction 10. So those are the 10 transactions. You would go through the same process. Take one side, less the other side, equal the totals. And I apologize for my error I had on my service revenue. I'll fix that for future templates. At the end of the day, this organization has now total assets of $52,700, consisting of these 3 asset accounts on the left. On the income statement, they had total income of $5,000. Total expenses, though, exceeded it, being $5,600, for a loss of $600. One other thing to point out is the capital account now consists of the capital, $47,000, plus or minus the net income. In this case, it's takeaway minus the loss of $600. Also take away the withdrawals that Cheng made. So we have $43,400. Plus the 2 liability balances equals the $52,700, being a balanced balance sheet for the organization.